All right, we'll go ahead and get started. So this is Attorney Chris Berry, certified LLC attorney and certified financial planner. And we do these weekly wisdom webinars uh, about every week. And it's really a time just to answer questions that are submitted ahead of time or on the call. And always I like to start with something positive that's happened over the last week. Uh, and we call it a positive focus. So big thing over last week for me, let me share my screen here. And so I've actually had two left hip replacements already. Um, and so I'm sharing my screen. So if you look to the left, that was when I had my second hip replacement in October. It's kind of dislodged, but the liner came out. Last Wednesday, I was doing this activity. It's called jiu-jitsu. It's wrestling. So if you look at the right picture, I completely dislocated my hip, which I have never felt as much pain ever in my life. Granted, I'm not a woman nor had childbirth, but this was like a level 10 amount of pain. You can see that my hip was completely out of socket. So actually I had to go to emergency. They put me under, put my hip back in, and it's a week later and I'm walking without crutches. So that's my positive focus, is that I didn't need surgery and still getting around. But yeah, that was not fun last week, I'll tell you that. All right, so let's get into the question. So I had a couple questions, all kind of revolving around the same thing. Obviously, with what's going on right now in the markets, as of right now, markets are down quite a bit. And there's been a lot going on in terms of talks about tariffs and things like that. So year to date, and again, this is changing like by the minute. Right now, we're about 13 and change percent down. Um, and we had taken a dip and then it was kind of rebounding, but still everything is down right now. Markets are down about 13%. And so I had a couple of questions regarding like the tariffs and everything going on right now. And to be honest, no one can tell you what's going to happen next. So really, when we're talking about portfolios and that type of thing, here, what I'm going to do is share my screen here and just some things to think about with regards to the tariffs and especially your retirement. And we've had a lot of conversations with our clients. And also understand that when we're looking at kind of the markets are always going to go up and down. And if you zoom out historically, typically at least once a year, the markets will drop at least 10% for whatever reason. And I think this is a very valid reason. The markets are reacting to the uncertainty. But here's some things to think about with regards to all this tariff talk and your retirement. So the first thing is going to be stock market volatility. Again, like I just shared in this slide I put together a little while ago. But right now the markets are down about 14% year to date. And that's really the S&P 500. You can have conservative portfolios. You can even have investments that are protecting against market downturns and stuff. So I would say like our clients are not down that much, but the markets overall are down that much. So I guess the first action item, and that's really what we're looking at, is, okay, here's events that are outside of control. What are the things that we can control? What can we do? So the first thing is take a look at, okay, like maybe we said we are aggressive in terms of our portfolio. We're aggressive in terms of, hey, we want the most return possible. And over the last couple of years, you've been rewarded with that because overall the markets have went up a lot, right? But understand that the markets don't always go up. There are hiccups, there are bumps, and the bumps could be short-term, the bumps could be long-term. So understand anything you have in the market, understand how much risk you're really taking on. And again, everyone raise their hand to say, hey, I'm aggressive. I want the best rate of return possible. but understand when you have things in the market, like there is a risk of downturn. And so that's what we're experiencing right now. So if, with what's happening right now, has you stressed out in terms of your financial plan and your investments, maybe now's the time to have a discussion with us or someone else with regards to your risk tolerance. So I was even sitting with some clients today who are they're moving some money over, and we're talking about we're walking them through the process that we have to do for compliance in terms of figuring out how much risk they're willing to take on. And as we're answering the questions, they were moderately aggressive, but then after about 10 minutes, they're like, you know what, I'm not really comfortable with that right now. So we kind of scaled things back. So the two things I would say with regards to the investments is one, make sure that you're really taking on the amount of risk you're comfortable with in your portfolio. And then the second piece of it is look at time horizons. So is this money that you're concerned about, is it money we're going to use over the next year, or is it money that we're going to use 5 years out, 10 years out, or even longer? Because when you zoom out, understand that, and I was just reviewing this with clients right before this, yeah, the portfolio is down 8%, but if we zoom out from the time we started working together, we're still up 6%. So just take into account time horizons, and also understand that time to sell probably isn't when the markets are down. So that's where, when you're putting together a well-defined financial plan, it should take into account that markets are going to drop at certain points. Okay. Next thing, understand with these tariffs, the cost of living may increase. The cost of goods sold is going to increase. We're going to pay a little bit more, especially for things that we're importing. So the idea is having inflation built into your income plan. Okay. And then also take into account what's going to happen with Social Security. So Social Security, typically we see an increase of, I think on average, it's about 2.6% a year. That's the average cost of living adjustment. And again, understand that that's lagging a little bit. But if we do see the cost of living increase because of these tariffs, then you're probably going to get more of a bump from Social Security. Keep in mind that could be eroded by Medicare premiums as well. And also that's really addressing the inflation issues, which could be an issue with these tariffs. Okay. And then Social Security taxation. So President Trump ran on the idea of not taxing Social Security. But again, there's a lot of things that were part of the agenda that we haven't seen happen yet. One of the big things is extending the Tax Cuts and Jobs Act. So as we stand here today, April 9th, the Tax Cuts and Jobs Act still has not been extended, which means taxes are going to go up next year. Likewise, as of right now, if you're a married filing jointly couple with more than $44,000 of income, still your Social Security is going to get taxed at 85% of your Social Security is going to get taxed. And then also understand, like with all of this tariff talk, like the cost of healthcare might increase as well. So I think, and again, I'm not an economist. I look at these things as there's stuff that's important that you can't control. There's stuff that's important that you can control. We're trying to figure out what can we do given what's going on. And so, yeah, I think overall with the tariffs, short-term things are, cost of everything's going to increase. I think the markets are going to be pretty volatile in the short term, but also understand, I don't want to get political with this, but understand the biggest thing moving into this year was looking at the amount of debt we had as a country. Right now we're at $36.9 trillion in debt. And we also had the Tax Cuts and Jobs Act expiring this year. So really, from our standpoint, the most interesting thing would be, how are we going to address this tax or debt crisis? And really, there's only three options. One was raise taxes, which no one likes. Two, print more money, which would create more inflation. Or three, cut spending. And then the fourth one that really no one was thinking about, there was really not on anyone's bingo card for 2025, was tariffs across the board. So I view this as looking at trying to raise tax revenue because that's something that had to happen. Whether it was raising taxes, printing more money, or cutting spending, and I guess adding tariffs on top of it. Like we had to address this debt crisis. And I don't think this is the most elegant way that we could address it, but it had to be addressed. So I think there's two ways to look at the markets right now. One is this is a short-term reaction, or two, this is the beginning of a recession. And so given that you have those two approaches of what you view of what's going on, and trust me, you have experts on both sides of the coin. From an investment standpoint, then the next question is, okay, what do we do? So do we move more conservative, move to cash, like selling when things are low? Do we stick with a plan, which most of my clients are doing because we have a plan that takes into account, hey, your now bucket, here's short-term conservative money, here's long-term money. And this was, if you're in a position to do this, maybe you lean into this dip a little bit and get more aggressive with things. So I had a couple of questions with regards to tariffs. Like we're not economists, but understanding kind of the financial markets and taxes, like we understand that they had to raise tax revenue somehow. So this is a way that they're looking to raise tax revenue without having to raise taxes. And so still the big thing that we're looking at is, okay, how much tax revenue is this going to raise? Are they going to cut enough spending that they're not going to have to raise taxes? Because I think that's the final choice is taxes are going to have to go up. I don't think taxes will ever be lower than they are right now. And so just like I had a meeting with some clients today, they had saved all of their money pre-tax, getting their retirement, and now they're looking at strategies to get money over to the tax-free side, looking at Roth conversions, so that if taxes do go up, they're not losing out on those pre-tax accounts. So, all right. So that is the tariffs, big picture. No one really knows. Like every morning, everyone's like, okay, what's the next thing? So that's kind of where we're at with that. All right. Here's some other questions that came in. Hold on. So I did have a question on like, what are annuities and do they make sense? So there's lots of different types of annuities out there. There's variable annuities, there's multi-year guaranteed annuities, there's fixed index annuities. So my first comment with regards to annuities is that there's a lot of people that are just insurance salesmen and all they can do is sell annuities. And so whenever someone comes into their office, if your only tool is a hammer, everything looks like a nail. So I think annuities as a whole are oversold, but they're a tool. And if you're looking at principal protection is something that's important, and still want some growth, then I think annuities may make sense as part of a portfolio. But if someone's talking to you about annuities, I would make sure that they're talking to you about a full comprehensive financial plan and then saying, hey, what are your goals? Here, what are the best strategies? And then here's some tools. And maybe one of the tools is an annuity. But if someone is just pitching an annuity right off the bat without figuring out like, what are your goals? What are you trying to accomplish? And then figuring out the best tools, they might just be an annuity salesman. They're probably not a certified financial planner or attorney. All right, here's some other questions. Do you help to set up ladybird deeds, LLCs for properties and trusts? Yeah. So a lot of our clients, they own primary residence. A lot of them have rentals. So one of the things that is the legal work part of it is taking care of the real estate. And so, yeah, especially if it's a rental, we're doing a lot of LLCs, setting up the operating agreements. We're doing ladybird deeds, which are basically beneficiary designations for your real estate. Sometimes, depending on the situation, we're setting up asset protection trust to protect the real estate as well. So, yeah, protecting the real estate, that's part of the legal work that we do, and we record everything for our clients. Even today, we delivered some documents to some clients today. They have to follow up with their banks to make sure that the trust is listed as a beneficiary of the different accounts. But we already sent in the deed to get recorded at Wayne County. It was a ladybird deed. We already got it back for them. So we do take care of that for our clients. Yeah. Another question. Will you continue with jujitsu? Um, might be my wife asking this question. I don't know. I'll figure it out, but I got to do something. I'm not ready to start gardening yet. All right, another question. If tariffs will be growing source of revenue rather than income taxes, Roth conversions seem less important, especially after Irma's factor in. State tax exemption does not seem to be at much risk either. Yeah. Okay. So the question here is, all right, if this deficit that we have is covered by tariffs and cutting spending, then maybe we should not do Roth conversions. And then the second piece of it is looking at what's called Irma, where if you get into basically the 24% tax bracket for a married couple that's over $212,000, you'll get into Irma. What that means is now you'll pay an additional Medicare premium. So there's two pieces to it. One is whenever we're talking to clients about Roth conversions or taking money out of their pre-tax accounts, paying the tax, and then moving it to something post-tax or tax-free, we're always having the conversation with regards to the Medicare premiums. And so if we're maxing out the 22% tax bracket, which is about 206,000, then we don't have any additional Medicare payments. Okay, so I think right now it's probably a no-brainer to max out that 22% tax bracket, because unless they extend the Tax Cuts and Jobs Act, your 22% tax bracket is going to 25% next year. And then kind of what you're getting at here is, all right, what if they raise enough tax revenue that taxes don't go up? Here's the thing. If taxes don't go up, if they remain exactly the same and you're being strategic with Roth conversions, you're breaking even. Like it's not, like there's no downside. The only time that it would make you would be harmed by doing a Roth conversion would be if you think taxes are going to go down in the future. So I'm going to tell you right now that taxes are probably the lowest they ever have been. And most people think there's no way that taxes can go any lower than they are now. So if you're in agreement with that, then taxes are either going to remain the same or go up in the future. If taxes remain the same, if you do a Roth conversion, you stay at the same tax rate, it has zero effect. Like zero effect on your net worth, has zero effect. But if taxes do go up in the future, whether it's next year, 5 years, 10 years down the line, then the Roth conversions are going to pay off. The only way a Roth conversion would be harmful would be if taxes go down in the future, which again, historically, we're at one of the lowest historical tax rates ever in history. So I think taxes are one of the biggest risks, but also biggest opportunities right now. So I think everyone should be looking strategically at their tax returns, looking at their pre-tax money, thinking about where they're saving money. And this is something really we've been banging the drum on since even before the Tax Cuts and Jobs Act. I remember talking about this in 2014 when we were $16 trillion in debt. So the only way that it makes sense, or the only reason you should not at least explore the idea of a Roth conversion, is if you think taxes are going to go down in the future. If you think taxes are going to remain the same or go up, then I would say at least explore the idea of pulling money out of those pre-tax accounts, paying the tax. Because again, even if taxes remain exactly the same, it's break even. Like there's no downside to it. So, and I can show you the math that proves it. Like some people say, oh, well, I have less money to invest. I'm like, well, understand if you invest at pre-tax, like you're not growing a nest egg, you're growing a tax bill. If taxes remain the same. So really all you're doing is growing a tax bill by leaving the money pre-tax. You're not growing your nest egg. You're not putting more money in your pocket. If you have $100,000 pre-tax, 80,000 tax-free, and assume a 20% tax, let's assume they're investing in the same thing. They both go up 10%. You might be saying, hey, well, the 100,000 went up more, but no, you still have to pay the tax at some point. So all you're doing is growing a tax bill if taxes remain the same. Taxes go up in the future, then doing the Roth conversion makes sense. If taxes go down in the future, which again, who thinks taxes are going to go lower than what they are now? Not a lot of people. If you think taxes are going to go lower, then don't even consider a Roth conversion. But if you think taxes are going to remain the same or go up, then I would look at strategies to pull money out of those pre-tax accounts. I think it's kind of a no-brainer. So, all right, that is all I have. With that, thank you, everyone. Make it a great week. Take care. Bye-bye. Bye-bye. Bye-bye.